Hey guys, Shelby Mathis here, and today we're going to be talking about SLATs, which are these Spousal Lifetime Access Trusts. I think that's what it sounds for, but I brought an expert to go over it so we can figure out why people are using it, and it is widespread right now. Like this is the go-to trust for estate planners as they're dealing with the expiration of the estate tax, which you'll get to know about here pretty quick. And I brought on John Anderson, our resident trust expert. John, welcome.
Glad to see you.
It's good to see you. So we're going to have to get into this, and I think what we do is we start at the very top. And John is a expert trust attorney and reviews these documents all the time, sees other people's documents, deals with our clients too, and we can talk about what a SLAT is and how they're used, what they're using them for, how you're going to get pitched this probably by your financial planner or estate planner, and and we'll give you the good, the bad, and the ugly, so you can make an intelligent decision. So let's do 10,000-foot view. John, what is a SLAT? What does that stand for? What is it? What does it do?
Yeah, so a SLAT, Spousal Lifetime Access Trust, is a type of irrevocable trust where one spouse creates it and gifts assets into this trust, so transfers certain assets into it, and the beneficiary of the trust will be the other spouse. So if husband creates a trust and he's got some properties, and then he deeds those properties into this trust, now the wife is the beneficiary. She can get the income and possible use of the assets in that trust.
Why would anybody do this? Like, hey, we're married. We have access to each other's assets anyway. If you're in a community property state, you're probably thinking, well, what's mine is hers, or what's mine is his, and what's his is mine. Why does somebody use this?
So the main purpose of it is to reduce estate taxes. If you take an asset and you give it away to someone else, let's say, and then you pass away, the estate tax is based off of the assets that you own or control. And if I've given it away, it's no longer mine, then I don't have to pay taxes on it. I don't have to pay the estate tax on it. So the idea is we're giving away assets to your spouse through a trust. And because they're in this trust and they're no longer yours, when you die, they're not subject to the estate tax.
Now, I could give an unlimited amount to my spouse anyway without worrying about the estate tax. So is this more to preserve the exclusion? And like, as we sit here today, the lifetime exclusion is 13.61 million, I believe is the right term. And then the married is double that, which is, I should probably pull it up. So I know. Yeah, it looks like it's around, what is that? 27.22 million, right?
Yeah.
So is the idea that I'm preserving both halves so I can get the higher amount? So this is really for people that are over the $13-14 million threshold, or am I thinking of it correctly?
So the way the estate tax works is it's either assets that you pass on after you die that are yours, or it's gifts that you make during your lifetime. So if I made $1 million gift to my kid, and when I die, instead of 13.6 million of exemption, I would only have 12.6 million because that gift reduces it. So when we're making a gift to this trust for the benefit of your spouse, we're using up the exemption as it is today. Now, with the Trump tax cuts, part of that was they doubled the exemption, but that's going to sunset at the end of 2025. So right now it's 13.6 million. And so I can make a gift for 13.6 million without there being any tax implications necessarily right now. There are other implications that may come down the road. But if that gets cut in half when the Trump tax cuts sunset, I've already moved it out while the exemption was higher. So I can kind of take advantage of the higher exemption now, as opposed to just waiting to see what the exemption is after I pass away.
All right. So I work my butt off my whole life. I accumulate assets and I pass away, and the government taxes me under an estate tax, depending on my net value of those assets, correct? Is it going to be the
Correct.
net, or is it going to be the gross?
It's the net value.
So let's just say that I have a business and it's really difficult to value, but it's worth 10 million bucks. Right now, I don't have anything to worry about because if I pass away, at least at the federal level, I don't have to worry. You always have to look at your state too. But at the federal level, I don't have to worry because it's below the 13.61 threshold, or if I'm married, I could go all the way up to that over 27 million. But the Trump tax cuts are going to expire, and that's going to move down to, I believe it was 5 million index for inflation. So it was probably going to be around 7 million or so, right?
Yeah, about 7 million is about what's projected.
So I could still be, if I'm single, I'm in deep doo doo. But if I'm married, I'm still okay under that circumstance, unless I have a bunch of other assets. And let's just say my estate is worth 20 million. Then I know that I could give away half of it to my spouse now, and I could lock in. It is something that I could lock in, correct? If I use up my exclusion, let's say I give away 13.61 million to my spouse, then Congress next year says, we're eliminating the estate tax exclusion. Everybody pays it on the first dollar you make. It's going to be horrible. I would still be okay, right?
Correct. So the gift amount is determined by what the exclusion is that year. Now you have to use the full amount. So for example, if I only made a gift of 7 million and it does sunset back down to 7 million, I don't get the 7 million on top of what the exclusion would be reset to. I have to either use the full 13 million or above what it's going to reset to. Otherwise, it doesn't do you any good.
So this is really for people that are over, let's say, $14 million of assets that are married.
Correct. At least 14 million.
Okay, so let's go through the math. Let's just say that I'm worth 25 million, and I don't do this. I pass away in 2025, where the estate tax exclusion is still there, and I'm okay. I live until January 1st of 2026, and I pass away at in the morning of the new year. I make it through the new year. Now, what would it be like if I have 25 million? You'd use the exclusion of at least one spouse, so there'd be 7 million, and I guess I could give the rest of it to a spouse. That spouse passes. Now we're looking at some serious tax hit, right? Now we're looking at having what would that be, about $18 million subject to taxation.
Yeah, so you'd have 18 million at a 40% tax.
Yeah, or you'd get both. You'd still get your 7 million each, so you'd get
Right.
to 14 million. So you'd have 11 million that would
11
be
million. Yeah.
11 million that would be taxable on the second spouse. So I think what practitioners are doing are saying, hey, if you're in a higher wealth category, you're at 25 million or whatnot, hey, let's give 13.6 to your spouse so we can lock it in. So the difference, and under our example, was the difference would be about 11 or 12 million, and then you can use your exclusion against that. So worst case scenario, based off of what we know today, we use our $7 million exclusion against it. Now we'd only have 5 million subject to tax instead of 11 million. Am I stating that correctly?
Correct.
All right. So now we've got that out of the way. So this is a trust, irrevocable trust. And what does it do?
So you transfer the asset into the trust, and you have a trustee who's going to be managing it. The beneficiary is now your spouse, but they're going to have limitations placed on what they can use the assets for.
So they can't just take the money.
No.
What can it be used for?
So it depends on a couple of different factors. One is, who is your trustee? A lot of times the way that I've seen it marketed is that they say that, well, you can have your spouse be their own trustee. And that is true. But the more connected the trustee is to the beneficiary, if it's the same person, the more limitations there has to be on what they can use the assets for. So if if your spouse is going to be the trustee, then you're going to be limited to what's called HEMS distributions only, which is health, education, maintenance, and support.
So spouse wants a Lamborghini. Spouse, like, let's say that I do this, I put this money into this trust. I've lost control of it, correct? Like let's say it's myself and my wife. I put this in a trust, a Spousal Lifetime Access Trust. She's the trustee. She's the beneficiary. I'm done. Right? I can't touch that money. I can't control it. Correct?
Correct. Yeah, you've got to be out of it. If you have what we call incidents of ownership, where you control the asset still on the trust in some way, it will always be included in your estate. So the whole idea is to get it out of your estate so it's not taxed.
Okay. And then in my case, let's just say my spouse can only use that for health, education, maintenance, and support. So if she wants to go buy a Lamborghini out of that money, can she do it?
Well, it depends. The way that the courts have interpreted health, education, maintenance, and support is they say that you can maintain the same standard of living as to what you're accustomed to. So if you were, frugal and you built up your wealth, and you only bought Toyotas your whole life, then that's all you can do after that. You can't use it beyond what you were accustomed to prior to the trust being created. So if you want to be able to buy a Lamborghini, you got to buy a Lamborghini before you create the trust. And then maybe you can buy a Lamborghini after. But even that is a bit of a stretch.
And you got to be careful, right? Because if the spouse is in control of this thing, the IRS's attack is going to be like you weren't being reasonable under HEMS, correct?
Correct. But it can even go so far as, if you've always lived in, a smaller home, if you wanted to upgrade your home, you wouldn't be allowed to, because you have to maintain whatever the same standard of living as what you had before.
But let's keep in mind that that's for the SLAT. Right. I'm still alive. So in my case, I put the money into the SLAT to protect it. So I know that I'm getting a 13.61 million exclusion. And I know that now. And by the way, you can give a spouse an unlimited amount of money when you die. It's just when they pass away, you're going to get hit with the estate tax. But here we're saying, hey, I'm gifting it to you, and you still have access to that money. You're never going to starve. You're never going to be without. You're going to maintain your standard of living. But I'm still alive. This is where I get my head starts to break. So what happens if you do this? Your spouse goes out, gets the Lamborghini, you get angry, you end up in a divorce. What happens to that money?
Two things can happen. Either the spouse keeps it, or a court can judicially dissolve the trust and distribute assets out, but you do not get your exemption back.
So you're done with the 3.61. It's done.
Yep. Once you make that gift, you cannot undo it.
So if they undo it, then is it counted back into the estate, or do I still get to use those monies as being separate?
If it gets undone, then no, those assets are going to be counted now as part of your estate.
Wow.
So you used up all your exemption. You now have some assets, and you're out of exemption to be able to offset the estate taxes after you die.
So that can be a $4 to $5 million mistake.
Correct.
If that happens. So that's it. Hey, baby, we can't get divorced. It's going to, when you pass away, it's going to cost the kids $5 million. We got to stay together. That's your argument, is you're going to get to make that. But otherwise, it's not coming back to you for the most part, right? They're either keeping it. Would it be under the same terms of the SLAT? So like if you get divorced, they take the SLAT. Would they get the other assets too? Would the court be looking at that?
I mean, the courts are going to look at all the different assets and weigh the options, or you can negotiate it with your spouse or your ex-spouse, how you want to do the split. So technically you could create an agreement where they keep the SLAT. Maybe you get some of the other assets, but they're going to still be bound by that SLAT.
But it's not your property anymore. You gifted it to them.
Yeah,
So
it's
like
not
it's
yours.
truly separate property. That's one of the beautiful things about gifts. Your spouse is like, this is mine. It's not ours. This is mine, not yours. We probably haven't seen much of that. Have you seen any cases where the SLAT got drug into it?
Yeah, yeah, it has happened. And a lot of times the way that it usually in community property states where it does get attacked, where the court can basically say you didn't properly
Mm-hmm.
um, separate it. Because in order to make the gift of the asset into the trust, you have to create an agreement that breaks community property,
Mm-hmm.
and then you can transfer it into the trust.
And then there's
Sometimes,
limitations on their ability to access it. So
right?
it's truly a gift, and there's restrictions. Do you let's just talk about, are there any other reasons you'd use this other than, so is there any other reason we would use a SLAT other than estate taxes?
Not really.
So
If you want asset protection or other types of benefits that you can get
okay,
from an irrevocable trust, there are better options than using a SLAT.
it's it could do it, but it's like using the wrong size screwdriver for to put in a to do it to use on a fastener. Um, all right, so I got to get my head around this a little bit. What goes wrong on these? I mean, you've seen a ton of these. I know you're reviewing them even as of today. What are you seeing are the biggest problems that occur with these SLATs?
Yeah, so the probably the biggest way that the IRS attacks these is the reciprocal document doctrine. This is a court doctrine that basically says if each spouse creates a SLAT for their other spouse, and you basically create them at the same time, you put similar assets into them, then the purpose for creating that SLAT wasn't for estate planning, which is what they're normally supposed to be for. It's simply for tax avoidance. And
Mm,
under the tax code, anything that's done just simply for the purpose of tax avoidance can be undone.
yeah. So anybody out there that's thinking, oh, these things are great. I'm going to do one for my spouse, and my spouse will do one for me. You may as well have not have done it. The courts are
Yeah.
just going to nix it and say, no, you guys did it. It wasn't. It was tax motivated transaction. We're going to put you back in the position you were before.
Yeah. So that happens a lot where, I mean, there was one I reviewed today. The documents were identical. The only difference was the name at the top was the spouse. The date that they signed it was identical. The funds that they wanted to put into it, or that their advisor was telling them to put into it, was identical. Um, Luckily, they hadn't fully funded it yet, and I told them, don't do it. Don't put any
Mm-hmm.
more into these. It's all going to get undone under the reciprocal trust doctrine.
So that's a big one, and that's pretty obvious. If you're not aware of it, if your practitioner's not aware of it, if whoever you're getting your documents has no idea it exists, that's the seemingly attractive point. Says, we'll divide it up. We'll use your exclusion now so you don't lose it if Congress doesn't act, and we go back and 2026, it goes back down to $7 million exclusion, and spousals together about 14 million. So if you're above that point, if you're over 14 million, then this is going to start. You're probably going to hear about this, right? You're going to have somebody talking about it saying, hey, you know what we should do? We should lock down your gift. And if we do this now, then you're never going to have to worry about it going down, which it is. It's going to go down. It's going to get eliminated. It's going to go down to $1 million, whatever they do. They're selling you into this idea of the SLAT. Now we know that we have the reciprocal trust doctrine. What else do we have that's a way to pierce this thing and destroy it?
So another common way that it's pierced is the incomplete gift, where either you retain too much control over the assets.
Mm-hmm.
Maybe they say, oh, well, you may have given up this asset, but we'll write into the trust that you have certain abilities to maybe undo some of it if you ever wanted to. Problem is, if you retain those powers, it's an incomplete gift. Or the other one I see a lot is you make the gift or the transfer into the trust, but you don't file the proper tax paperwork. When you make the gift, you have to file a 709 tax return. I see this all the time where the 709 was never filed, or nobody knows where the 709 is, right? Maybe they did this 10 years ago and it's
We were
lost.
just dealing with that on a substantial estate,
Yeah.
and they never filed it. They just didn't. They keep saying, "Oh, we made a gift of this, and it was millions of dollars," but there's nothing to back it up from a tax standpoint. Like, mom and dad continued to even make payments on things like property taxes and stuff, and it was like that gift never actually happened. You guys just
Yeah.
said because we said it did, it did. Doesn't work that way.
Yeah, you got to remember when the IRS audits these, the burden of proof is not on the IRS. The burden of proof is on your estate. And so they have to produce all the paperwork showing this is a completed gift. This is the amount. This is the proof why this amount is correct. So if you transfer a business and you just say, oh, it's worth $5 million, where's the proof? Did you have a professional business appraisal done? How do we know what the value of that gift actually was when the gift was made? Did you make, or when stocks were contributed, did you actually, show that the value of those stocks on that day was what you said it was? So and all this paperwork has to be retained until at least 3 years after you pass away. So, because your family has to file an estate tax return after you die, and then that's when the statute of limitations starts ticking, and they have 3 years after that return was filed to come back and audit you. So you have to have all of this paperwork available if they ever do come back to audit you.
What usually happens with these when you pass? Do they just automatically distribute to the kids? Does it go to a living trust? Does it go to some other trust? What happens to these?
Usually the SLAT trust itself will identify how things are to be distributed.
Mm-hmm.
And I mean, you can do as much as you want there. You can have it immediate, you can have it stay in trust, create something where you have a legacy that goes on for multiple generations. There's lots of different ways to make distributions from the trust.
Okay, so we went over a couple of things: the reciprocal trust document, having too much control, not following HEMS. Anything else that can cause this thing to get destroyed?
Another way that the trust will often get pierced through is so we talked about HEMS and how your spouse has HEMS, but if you start taking benefits from the trust, or your spouse takes out a bunch of money but then starts using, conveniently transfers it into the bank account, and you're the one that's spending all the money out of the bank account, yeah, that's a problem. So you've got to be careful about where's the money going. Is it going into an account just for the spouse? And are they the one that is spending the money from that account, or are you having control over that account and being able to spend the money as well? Because it's not HEMS for you, it's HEMS for your spouse and maybe your kids too. You can throw your kids in there too, but not you.
All right. Now, this isn't the first time we've had this fire drill. I want to say like it was, God, what was it, 2010 or something like that. We had the same thing where one year the estate tax exclusion went away. It was unlimited. I think that was the year the Steinbrenner, the Yankees owner, passed away and didn't pay any federal estate tax, even though he had billions of dollars. So he timed it perfectly. But I remember one case where some kids were the beneficiaries of a limited partnership that was put together and funded via gift of dad transferring a building into it. Very low basis. And then when dad passed, the estate tax, and it wasn't even there. He had already gifted it over to him. but they lost the step up in basis. Like if dad had passed, there would have been no tax. So the year that dad actually did pass away, the estate tax was enough to where there would have been no tax. But because they did the gift ahead of time, they lost their step up in basis. And now these kids, when they were selling the building, it was several $1,000,000 of tax that now they had to pay that would not have been there, but for the fact that dad got with his financial planners and did this transaction. Is that the same thing that could happen here?
Yeah, so if an asset is not subject to the estate tax, it does not get a step up in basis. So
Right. And just step up in basis, just explain that maybe quick.
yeah, so step up in basis, if I buy a property for $100,000, that's my basis. And if it's worth $200,000 and I sell it, the tax is the difference between the basis and the sell value. So if I die and it's worth $200,000 now, my basis resets to the fair market value on the day I passed away. So now my basis is, or the basis in the asset is $200,000 instead of $100,000. And so if it's sold immediately after I die, there is no capital gains because the basis and the sell price are pretty much the same.
So let's say it's a case where you're worth 20 million bucks and you take 10 million and throw it in a SLAT. 5 years later, that thing's worth 15 million. The estate tax they've eliminated the estate tax. But now when your kids go to sell that, instead of having hey, I have a zero tax bill, now I'm going to have the difference between 10 million and 15 million. I'm going to have a $5 million tax hit. That could be capital gains, for example. Maybe it's long-term capital gains, and it's going to be at the 20% plus the 3.8, like, plus your state. You could be looking at many, many millions of dollars that didn't have to happen if you just left it alone. So I'm always one of those guys that I've seen it happen enough to where I'm like, don't be gifting those assets. I see why people would use the SLAT here, especially if they have substantial net worths. If we have the people 30 million, 40 million and above, you want to lock it in. You don't want to get completely smashed. Coupled with some other strategies, maybe they're looking at some end of life decisions, or giving some assets away, things like that. But I'm trying to figure out other circumstances in which you'd use these. Is that literally it? Am I missing it, or are there other reasons why you'd be using these SLATs?
No, that's pretty much it, is to reduce the estate taxes.
All right, John, is there anything that we're missing here that somebody else needs to know about these things so they can make an educated decision?
I think another way that these kind of can come back to bite you is, let's say we're being careful. We're not doing the reciprocal trust doctrine. So we're just going to use one, and we're going to save our spouse's exemption for after we pass away. Mm-hmm. So I use up all of my exemption and I gift it in everything to my spouse, and then my spouse dies. Everything that I had given to that trust is gone. Right. Yep. I may have been able to get some peripheral benefits while my spouse was alive. Right. But now that they've passed away, everything moves on and I have nothing. So a lot of times what you're doing is you're trying to guess which spouse is going to die first. Mm. And I have seen it many times where the wrong spouse dies first. Mm-hmm. So the assets are now moved on. You no longer really have access to them, and it can create some pretty bad issues.
And there's probably advisors out there saying, "Don't worry, we can draft around that." No, you can't.
No.
Right. The more you try to draft around it, the less likely it's going to be a gift, and it's not going to be valid anyway. Interesting stuff, Mr. Anderson. I appreciate you coming on and explaining it. Is there anything else that I'm missing here that these folks would need to know to make a good decision?
I would make sure, if you are talking to someone about the SLATs and how to reduce estate taxes, that you look into other ways as well and kind of weigh the different options, because the SLAT is not the only way to reduce estate taxes.
Mhm.
There are other types of irrevocable trusts that can do it. There's charitable giving that can be used to reduce the estate taxes. And sometimes that may be a better option than going through the SLAT. So make sure if you're working with someone to do estate tax planning, that you get all of the options, not just getting pushed into one option that seems beneficial at this time, because that's what a lot of these marketers are doing. They're trying to push people into one product, saying this is the best thing since sliced bread, but it's not the only option. And estate tax planning is incredibly complex, and there are a lot of pitfalls that you can fall into. So make sure that the person you're working with has considered multiple different options, and that after reviewing those options, if the SLAT you feel like is the best option, then you can use it at that time.
So I'll say this: John, I'll put your contact information in the show notes, and I'll make it easy for folks if they want to have a discussion with John or his team. Just type in strategy in the comment section. Just type in the word strategy, and we'll set you up with somebody who can take a look and see what it would take to either go over your options or review what somebody else is proposing to you, so you can get a good second opinion. So please reach out, and since we're on YouTube, like and subscribe. And if you know of anybody that could benefit from this information, please share it. John, thanks again for joining us.
Well, thanks for having me.